typically we have tenants that are, a manufacturing company. They make B2B products, everything from, government aerospace parts to, contract hair and skin product manufacturers. They make big voluminous vats of, say shampoos that they sell to a retail oriented company that puts their own label and does all the marketing and sales. We had another tenant recently that did industrial dryers and mixers, and they literally made these giant blades. Imagine a KitchenAid sitting on your kitchen counter, but 12 feet tall, and they're making these giant blades and dryers, for these type of things. And, everyone from 3M uses it for, glues and, slimes.
All right, guys, welcome again to another amazing episode. Today we have Neil and Drew Wahlgren. For the Swedish people, I had to say with that accent. So Neil is the COO of Mag Capital Partners, and Drew is the capital markets director. And they are brothers just like us, and they are crushing it in their lane and in their world. And we just love to hear it because, we hope to, continue in our path and be in their shoes at some point. So let's dive right in. Neil and Drew, I don't know who wants to go first, but give us a little background about both of you. I know Neil's prior military, and Drew don't know that much about your background before all this, but yeah, dive into it, how you got started and how you ended up in real estate and in this MAG group.
Yeah, I'll kick it off here. So first off, thanks for having us on, guys. So Neil Wahlgren here. I've been doing commercial real estate for about 6 years, and I got into it through somewhat of a unique pathway. I had a personal family friend who had started a equity business, and I was just moving back to the Bay Area for some family reasons. And just got to talking, and he had, really was telling me a little bit about his business and what he did in his company. This friend had built really an equity investor focused business where he had a network of investors that he would raise money from. And then what he would do is he would partner on a deal by deal basis with sponsors, commercial real estate brokers, really guys and girls who had, talent in putting together a solid commercial real estate investment project, but lacked access to investor capital. So they would kind of partner on a JV basis, deal to deal. And it was really neat. So I came in there, kind of learned the ropes and worked my way up. And what was unique about it was really we got to work with a number of different sponsors. We had about 6 or 8 different folks, all with very unique specialties. So for example, we had, one sponsor who is our multifamily sponsor, and they strictly did multifamily value add in the Southeast. We had another one who was our multi-tenant retail guy, and he was in the Dallas-Fort Worth area, specialized in that particular sub-asset class. And we got to see, how he structured deals, how he weighed risk and investor returns. And then, we had another one who did office, another one who did multi-tenant industrial. And one of the last sponsors was a group, Mag Capital, that we had partnered with. And Mag Capital specialized strictly in single tenant net leased industrial. So again, all these, each with their own, specific nuances. And it was really neat just to kind of grow and understand the space in a way that you really can only do if you deep dive into the underwriting, deep dive with different experts in the field, and just come in with an open mind. And so I did that. I was running operations and overseeing overall, investor growth and capital raising for that previous firm. And then after 2 or 3 years, had an opportunity to fully partner up with the folks over at Mag Capital. So that company, principals Dax Mitchell and Andrew G. And really, we just got along with them on a personal level and really liked the model and its simplicity. Really just not a lot of moving parts. Or let me rephrase that. Most of the value add and moving parts all happen kind of prior to a deal actually being ready to raise equity from investors. So a lot of that comes, and we'll talk about it in a little bit here, but just the net lease part, you're not only are you negotiating the price of the real estate, but you're also negotiating the terms of the lease. So really a lot more nuance than just buying an existing property with, existing leases and tenants in place. But I've been COO and with that team for about 2 years now, full-time, overseeing kind of internal operations, raising capital for the projects, and have had the unique opportunity to be able to do this with my brother, Drew. So I'll kick it over to you, Drew, and you can tell us a little about kind of your individual journey.
Sure. Yeah. Years ago, Neil was, like he said, he was working with this company that was partnering with other sponsors. And, of course, being brothers, we're tight. We hang out quite a bit. And we'll have, a beer and talk about what he's doing in his work. And so I got kind of an early understanding. And at some point I sold a house and said, well, and I had weighed out renting out this single family home. And, and I had a few kind of heart to hearts with Neil talking about, hey, what should I do here? And really that's that fork in the road that a lot of people come into, which is, do I want to be an active real estate investor or passive? And, just looking at everything and having all those conversations with Neil, it was, usually he draws me into a lot of bad ideas, but this, more risky, but fun ideas. No, but this was very good advice. And so I sold that house and started using the proceeds and actually invested with the sponsor group he was with, as well as kind of got plugged into other sponsors out there. And that kind of started my learning journey. And at a certain point, I was ready to leave, the very corporate gig I had at a large insurance company, doing, a vendor program and managing risk. And I said, hey, this is, I'd love to make this jump. I'm so tired of doing this, where I'm at, and I want to come into this full time. So Neil and I both jumped ship and really merged our small group of investors and our efforts over to Mag Capital Partners. So that, like I said, back in 2019, that happened, and it's been a great journey. I really kind of leveraged the network I had and really began to grow that. And then I've kind of, we both sort of evolved into helping on the acquisition side too. So it's been a great journey.
That's awesome. You're muted, Jeremy. You're still muted.
He's saying,
what is going on, man? I don't know what happened there. Let me step back just a little bit because I'm curious. Now that I'm near my retirement and I talk to people that are looking into the next path, right? Neil basically started this whole venture with you guys, and you're prior military, and you say you moved to San Francisco for family reasons. How or what type of background do you have in the military, or what type of background do you have to land this gig where you started working with this company and that basically exploded what you guys are doing right now?
Yeah, great question. So my background, very different from real estate. Right after high school, I actually went to university at the U.S. Air Force Academy out in Colorado Springs. So it's the basically Air Force equivalent of West Point for the Army, Naval Academy for the Navy. And so spent 4 years there, got my undergrad, majored in operations research, and was fortunate enough to land a pilot training slot afterwards. So went on a couple of years of flight school, a bunch of different bases out in the Midwest, and then ended up getting fully certified on the C-130, the Hercules. So arguably the best plane in the inventory. Depends who you ask. But no, I think most Marines can respect the.
I loved it.
The workhorse of it. Yep. I love it. Anyone in the Army and the Marines, especially, they're like, yeah, I've spent probably too many hours on a C-130. But yeah, it was a great experience, and got to live in Asia, out in Tokyo for a couple of years, deployments to Iraq and Afghanistan, supporting OIF and OEF there. And really, during that progression, and the Air Force is fortunate because they really value, especially on the officer track, they value master's degrees. So during that period, I was able to actually get an MBA from Texas A&M. So that was really kind of my first foray into the business side of things. And, still deciding whether I wanted to go, be a lifer or possibly pivot, and had an opportunity actually to get out a little bit early of my active duty commitment by doing a reserve transition. It was a program because they were kind of downsizing some of the active duty C-130 component air crew, and said, hey, what better time to mix it up? So actually I switched over and joined the Navy. Better looking uniforms, same plane, but really the main reason, the Air Force, reserve and guard bases are all, kind of in the middle of nowhere, and all the Navy ones are right on the coast.
Yeah.
So I ended up being able to get picked up by a Navy Reserve unit in Point Mugu, which is about 6 miles from Malibu, California. We would take off.
Nice.
The end of the runway was the sand, and you just take off over the Pacific Ocean.
Nice.
Pretty good setup out there. So, I was living in Ventura. I was flying part-time and actually landed a gig working for a renewable energy startup. And so that was interesting. Really got to, kind of take that MBA, really, I was qualified on paper, but it was my first, transition over. And what was interesting, people are always, that first jump into the civilian side, always the hardest. And I came in actually as a project manager and kind of sold my experience of, hey, not only am I a pilot, but I'm managing a crew of air crew, really, multi-crew aircraft. We had co-pilots and navigators and load masters and flight engineers, flight mechanics, all this stuff. And so you have to, know their specialties and get everyone more or less aligned to get them, really where you need to be and, accomplish the mission there. So there's a lot of similarities with project management. So I worked with a team of engineers. We were building this demonstration plant with this really technology where we would convert wood waste feedstock into a gaseous form of gasoline. So it was really neat. And it was a way to substitute some of the petroleum-based hydrocarbon elements with plant-based alternatives, but molecularly identical. So fortunately, the company didn't make it long-term because of some funding and cost viability issues, but neat experience. And really, it was, kind of that first jump to say, hey, do I want to stay in the reserves here, or do I want to, kind of jump into the private sector? And I really like the startup world, kind of the risks, the nimbility it allowed. And, really you could kind of just, stick your neck out as far as you wanted to go. And, you might get schwacked, you might not, maybe you come across something great. But just, I found I was drawn to that level of, kind of freedom, flexibility, adventure. And it was kind of a transition. And what was kind of wild for me was I found psychologically, I actually got a lot of the same kind of endorphin rushes from pursuing, business ventures as I did flying. And, it's hard to explain sometimes to people, especially if they've stayed in the cockpit, but really it kind of triggers a lot of the same pieces of your brain when you're just really engaged on something like that. So, I still fly for fun, but it was a good transition in that respect. And really having had that startup experience was, kind of what made me, qualified and suited for doing the jump over to that initial commercial real estate venture up in the Bay Area.
Nice. Cool. I think you hit on the key point there, because I think when you're in an operations role in wherever you are, you can relate, because it feels like you're in control and you can choose the right people for the right jobs and help massage the team and accomplish something. And that's always super rewarding for anyone who's been in a leadership role, right? So yeah, that's pretty cool. Drew, so how about you, man? Because what made you jump from passive investor and say, hey, I want to leave corporate, and why? What made that happen?
Yeah, I think it's, entrepreneurship runs in our family a little bit. I think our entire family has had their own business. And before I was in the corporate world, I had my own small business, totally unrelated, but, distributing drinks and snacks to cafes and restaurants around the Bay Area here where I live. So that was, something in my early days, and I actually left school to do that because it was a great opportunity and really got a lot of real world experience. But, eventually markets tanked and a lot of my customers went out of business, went back to school and finished with a finance degree, and ultimately transitioned into this corporate world. And I kind of missed having, exactly what Neil's talking about, just having ultimately kind of day-to-day risks and rewards. And it's just, it's living, really. I mean, just having something that's a little bit more stable is great. And it works for a lot of people, especially when you have dependents. But really, I kind of missed that. And I was looking for a way to jump back into that. So kind of investing as a limited partner in a lot of these deals, it was good experience for me to get my feet in the water to really get a sense of how different sponsors are operating, what the deals looked like. Ask Neil a million questions because I did in the early days. I wanted to know all of these little nuances. Hey, why do they do this? Which is better? And really kind of gave me an opportunity to feel it out. And, I had never sponsored a deal, but I had gotten quite a bit of experience there. And so just wanting to get back into a more entrepreneurial role, as well as kind of that experience with syndications and sponsors that put together these deals, kind of ultimately led me to a path where I could say, hey, look, I can leverage the network I have and expand on this and bring equity to these deals, because I ultimately am its number one fan, right? I had invested with this company before I joined Mac Capital Partners. So I really, you have to be a believer in order to kind of bring the product to people and really show them why it's great. So that's kind of the story there.
Oh, that's sweet, man. So then let's talk a little bit about, net leases. So most of our podcast guests are towards multifamily. We've had a few in the storage business, and then in the fund creation business. So tell us a little bit about net leases and how that actually works.
Yeah, absolutely. So I'll take the kind of fundamentals here, Drew, and then I'll kick it over to you for some of the nuanced pieces. But really, there's two main components of what makes our model unique. And one I would talk about is the single tenant net lease piece, and understanding how that kind of mitigates some risk and isolates the remaining risk in a way that's understandable for us and for our investors. So really, we come in and we are setting up new leases on these deals because we acquire them through sale leaseback. So before we hop into the lease part, it's important to kind of understand how deal flow happens for us on these. And so typically we have tenants that are, a manufacturing company. They make B2B products, everything from, government aerospace parts to, contract hair and skin product manufacturers. They make big voluminous vats of, say shampoos that they sell to a retail oriented company that puts their own label and does all the marketing and sales. We had another tenant recently that did industrial dryers and mixers, and they literally made these giant blades. Imagine a KitchenAid sitting on your kitchen counter, but 12 feet tall, and they're making these giant blades and dryers, for these type of things. And, everyone from 3M uses it for, glues and, slimes and adhesives that they make to, even General Mills uses it for cereal. I mean, just those kind of products that really just drive the gears of the economy. And, they're great tenants because most of them have been around a long time. They've been around 30, 40, 50 years. They have really solid financials, or at least the ones that we go into, pursue as a real estate deal. And, they have deeper cash reserves than, small companies or individuals do. So you're coming in, and yes, there is a concentrated tenant risk because it's single tenant. But if you understand the economic fundamentals of that tenant, it's quite an understandable risk. And so that really carries over to the second piece, which is the net lease. And so the net lease is just another word for triple net. And really that means that our tenants are handling 100% of the expenses, both known and unknown. So we are completely removing that expense piece from the operational risk of our investment. That means they're handling taxes, they're handling insurance, they're handling maintenance, they're handling utilities. And these are actually absolute net leases. So they typically include roofs, they include, heating and air, HVAC, pavement, landscape, really anything that comes up is going to be the responsibility of the tenant. So that means, I mean, really our operational cash flow monthly bank statements are among the most boringly simple you ever see. You just have rent come in, you pay the mortgage, you pay your investor, 3 transactions a month. And it's great, so a lot of that churn, a lot of that value add, a lot of that, hey, I think I can, improve this product to hit a certain benchmark. We do a lot of that really in the pre-negotiation in designing that lease. And we use institutional grade leases, designing the purchase, really the cost of the building and the terms of the lease, and really finding a way to kind of mold those two in an art form and a way that's a win-win for the seller who's turning around and becoming our tenant. So that's how we get those under contract. And that's really the structure of the deal that we both take, real estate debt on and then raise the balance through investor equity.
Awesome.
Yeah, just to add to that, what that does for an investment is it just makes it more predictable as far as cash flow goes. So, I often compare what we do to multifamily just because it's a really popular asset class. But, I've talked to lots of investors and even sponsors where they've told me, hey, these expenses, sometimes they come out of nowhere, so there's a lot that you can underwrite for. I know what my landscaping cost is going to be to make sure my, hedges look beautiful, but sometimes an elevator is supposed to last 30 years and it lasts 15, and it might be a $70,000 repair or replacement, right? So things like that can happen and really erode cash flow if you're not in a net lease. So having that is really beneficial for us, where it makes it easier for us to really look and point to the underwriting as much more, there's a lot less risks that could erode that cash flow. So it makes it very nice there. And, we still work with these tenants as they, want to do repairs or improvements. And we have facilities managers who kind of coordinate that with them to make sure it's done to our liking. But ultimately the cost falls on to the tenant. So, and these tenants are all very committed to the locations. They've been there for a long time, like Neil said, and they plan to be there for a long time because we are executing a brand new 15 to 20 year generally lease. So they have a lot of commitment there. So it's never a sort of a battle with a tenant. They're planning on being there. They're very invested into the property and the building. And usually they've already got plans for, 6 months, 12 months down the road. They want to replace part of the roof. They want to pave the parking lot because they take pride in the facility because they've been there for so long.
Sorry, German, go ahead.
No, I was just going to ask. So I don't know. I mean, and this is probably one of those basic questions, but for people that are saying, okay, the tenant takes care of all the maintenance. Do they have to come through you to, for example, like you said, paint the parking lots? Do they need that approval? Do they need that constant communication with you guys, or they just for 20 years their building is theirs and they just pay rent to you guys?
Yeah, no, great question. Because we are the owner, so we don't want them just, building stuff, doing a little DIY project, right? So no, there's provisions that say they have to just basically run it through management. We sign up. Typically, there's a dollar limit to say, hey, anything above this level needs, landlord approval. Similar to what you would have, just on a residential lease as well.
Okay.
You're handling light bulb changes, but anything above $5 or $1,000, you're coordinating with the landlord to make sure that those repairs are done in a way that they want long term for that unit, right? So we have a lot of degree of control on that, and we can actually dictate, coming in when we're buying a building. Sometimes there's deferred maintenance, right? Sometimes there's a roof that probably should have been replaced 4 years ago, and a lot of times we'll come in and kind of give them two options and go, hey, we can either withhold some of the proceeds you're going to get from the sale, and basically hold this until you can draw off it to pay for the new roof, but we're going to kind of escrow this. Or sometimes we'll come in and go, hey, if you're more interested in proceeds, we can pay for that new roof, and we'll amortize the cost of that new roof in the form of a higher rent. So we like to be it's a long-term relationship, right? We're in this. They've been in place a long time. We're signing a new 15, 20-year lease. So we're looking to really have a predictable long-term relationship in a way that we can, kind of work almost as a private lender for them if needed to amortize some of that needed work. and it's a win-win. We're getting a better, better looking facility that, is kept up and really, up to standards. And now they are, finding a way that they can get those repairs done without having to impact that, net proceeds coming from the sale of the real estate.
Oh man, that's a very good strategy. I like that piece where you basically become a private lender. You're also, I imagine you charge interest on that. That's smart.
A lot of ways you can, skin the cat there. So.
Yeah, because they rather pay smaller amount over a long period of time. So I was going to ask before that is, you mentioned most of the, the value add is done in the agreement. So if they're paying all expenses, you're eliminating your expense column, but then how exactly are you negotiating for, well, I imagine rent bumps, and projecting, because I imagine you're also projecting the value of the asset over that 15, 20 year. Yeah. How do you calculate that? How do you make that happen?
And Drew, you want to talk a little about how the rent bumps correlate to NOI and kind of a guaranteed value lift there?
Sure. Yeah. Most of these, I've never seen a long-term commercial lease that for a single tenant that doesn't have some kind of rent bumps. And, they can be designed a number of different ways. Usually you see maybe a 1.5% to 3%, somewhere in that range. 2% is pretty common. We're seeing more leases just with some, currently fears around inflation, having some lease bumps or rent bumps that center or are tied to cost of living in the area, cost or rise in inflation. So, but either way, there's always going to be some kind of increases. So, if we're purchasing a property at a pretty conservative rate, let's just say, and maybe it's a 7.25%, right? 7.25% cap rate, then we feel pretty confidently that, properties are currently trading between a 7 and 7.25, and we were kind of on the high end of that cap rate there. So we feel good about it. We come into it, and conservatively, we assume that we're going to be able to sell the property, let's just say 5 years later, for 7.25% cap rate. So as time goes by, we're going to have 2, maybe 3% rent increases over that time, all the while paying down the principal of the loan we have with the bank who's financing the property as well. So we're kind of creating value in both those ways. And, if we have the same cap rate that we purchased a property for, then obviously our net operating income has increased, right? We don't have any expenses. We've already eliminated that with the net lease, and we have increases in rent. So, we may have a pretty significant jump 5 years later in the net operating income, which correlates with that cap rate. And of course, gives us a higher exit price when we go to sell. So, this is not a value add kind of deal, it's certainly not. But as far as, where we come in, the value that we create is oftentimes at the acquisition. Usually we're able to get better than market cap rates because of that sale leaseback structure. It's not something that every sponsor or buyer is willing and able to do. It's a lot more nuanced, a lot more important questions to ask and answer with the right kind of structure and creativity sometimes. So because of that, we've kind of we've built kind of a track record and have brought in some off-market opportunities because people now know that we've been doing this for quite a while in the sale leaseback space. So I'm not going to say that we get a half off, of course not, but oftentimes we're able to get that off market opportunity, and a seller who wants to get what's ultimately a financing transaction done is looking for a reliable buyer. So oftentimes they'll work with us a little bit, and we're flexible with them. Like we talked about earlier, there's a couple different levers we're negotiating with: acquisition price and lease rate. And sometimes one is more important than the other, and we can kind of work with them to meet their goals. So because of that, we're usually able to negotiate a little bit better price. So oftentimes that's what we're looking for, is that built-in equity on acquisition. And then of course, building that value over increased rents over time.
No, that's a great explanation. That leads into the risk factor, right? Of every asset class has their own risk. What is it? Is it ever tied to the tenants? Because their business, their NOI, as far as like, hey, maybe the contract would say something as far as like, hey, normally it would be 2-3%, but if you have a certain decrease in NOI, we won't raise it a certain amount. I'm just thinking of what happens in a downturn, or I mean, I get it. These are very
where's the risk at?
very strong companies for industry, but where's the risk at in this asset? So, or you guys don't see any?
Yeah, no, there's always risk. If anyone tells you there's a deal without risk,
yeah, exactly.
Yeah, if it looks too good to be true, it probably is, right? No, I mean, yeah, I mean, we really, the attractiveness of these deals are, there's a bump on the end that usually happens in terms of profit, but I mean, really what with a high degree of certainty is that stream of cash flows that comes from the rents, right? And we talked about the straightforwardness of it because you are removing that expense component, so that those cash flows are guaranteed by the lease. So they are as strong as the lease, and the lease is as strong as the tenant. So once you kind of understand that relationship there, everything really comes down to how sure am I that this tenant is going to follow through on their lease obligations and not default on that lease. So a lease default is what I want to avoid, right? And through that, what we do is we come in, and there's kind of two ways to look at tenant credit to understand what that true risk is from a tenant. So you have what's called, the industry calls them credit tenants, and credit tenants typically have annual revenues of over 100 million. And these are going to be big companies, your Amazons, your Walmarts, et cetera, And credit tenants often will come in, or publicly traded companies usually qualify as credit tenants because they all have outside credit agencies that give them a very formal score, right? You'll have a Moody's score, a credit report, S&P comes in, they give you, an AA minus, credit report, whatever it might be. And now everyone can look at that and say, hey, we all agree that this is the relative riskiness of this tenant, right? We play in what's called sub-investment grade. So most of the tenants that we have in our real estate are, usually about 60 to 80 million in annual revenues, still very profitable. Most of them have double-digit EBITDA margins, low debt, but they don't have an outside agency coming in. So what we do is we actually have a credit advisory team on staff. So we got 3 guys. All they do full time is basically do a deep dive into all the financials, the revenues, the EBITDAs, your debt, your quick ratios, really all the financial pieces. And they kind of spell it out in what we call a credit memo. And we actually provide that credit memo as an addendum to the investment summary to our investors. And it lets them kind of deep dive into really just a plain language narrative on, hey, this is why we think this is a safe bet. This is why we think after this company gets the proceeds, for the 5 years we plan to hold this piece of real estate, we think this is going to be a viable tenant. And it's really interesting. So we're able to kind of encapsulate that risk. And the reason we're able to get better returns than, say a credit tenant is because we're playing, and we actually focus on the arbitrage between the perceived risk of these smaller companies and the actual risk. And that delta between those two is where we capture value. And that value is why we're able to typically deliver, high teens returns from these investments. Whereas, if you had a piece of real estate with Amazon, your risk is almost zero, but you're probably only going to get, 3-4% a year if you're lucky in cash flow, just because that building is going to cost so much more because you have such a low risk tenant in there. So that's, you kind of choose the I'd say category you want to play in when it comes to credit. And we play in that just high level sub-investment grade tenants, and we do our own credit analysis. And really that's kind of how we're able to understand that value really well and still, feel like we're making a good play.
Gotcha.
Yeah,
so
just to
about
add,
the tenant.
I think, these credit tenants we're talking about, like Amazon, Home Depot, Walgreens, these are, single tenant properties that they occupy, that they're tenanting. And when one of those properties goes for sale, I mean, there's not a lot of unknowns there, right? It's almost closer to a commodity in that we have this sort of well-defined and understood credit rating of a tenant that's usually very strong in these cases of the companies I just listed. But it's really just a matter of, okay, what's the property? What market is it in? And, even if it's not a great, a growing market, well, it's a Walgreens, and it's in a town that's got 70,000 people. And guess what? Walgreens isn't going to go pick up and leave anytime soon. They're a strong company. We all know them, right? So it attracts a lot more buyers. And because of that and the strength that the strength of that tenant, it commands a much lower cap rate. That high price is not going to give you the kind of yield that most investors are looking for. It's really a place that we see a lot of institutions and REITs going to find something that's safe, cash flowing, easy to manage. And, sometimes we work with some investors who say, yeah, I own a property, a triple net property. It's a Walgreens. Once again, use that example, but, and they'll tell you all day long, they go, yeah, it's safe, it's easy, but it doesn't yield very much. And there's a good reason for that. It's like that trade-off of risk and reward we see everywhere. So that's, why we find so much more opportunity over here. And like Neil said, there's a perceived risk here, but once you really open up the hood of that car and take a look around, and you really find some strong companies that have been in business for a very long time and very profitable. They're just privately held, not well known, and it takes a lot of that work on the front end to get there.
Pretty cool, man. So how are you guys finding them? Is this normally through a broker relationship, or is there any opportunity for off market? Because I know, there's certain things that a broker is the only way, right? Is this one of those?
I'd say the vast majority. So Dax Mitchell, the managing partner, he's the founder of Mag Capital, and he cut his teeth as a commercial real estate broker. So he's really taken lead on acquisitions, and most of the deal flow, almost everything's off market, and not really because, we just have exclusive relationships. There is some of that, but a lot of it's just because the sale leaseback space is so kind of small and nuanced that it really is heavily relationship based. You're not just putting a deal on the market looking for a buyer. You're looking for someone that can negotiate both pieces, that can close on a deal. And really the amount of people in our space that can do that, there's probably 24 maximum. So, they all know each other and they call each other. They do a lot of buying and selling of sale leasebacks from each other. And, it kind of works out. But I would say our standard deal flow, we mentioned that manufacturing tenant. A lot of times what'll happen is, the founder of that company, maybe grew it for 40 years, solid company, good financials. She's looking to retire, right? So they sell the company to a private equity firm. That private equity firm buys the company. And that company comes with the real estate quite often. And the private equity firm is interested in growing that company at a much faster clip than it was previously. They want to pump it, full of capital in the right areas. They want to add manufacturing lines, pay down debt, all this stuff. They can't get the returns they're looking for from owning real estate. So that's their motivation to sell. So they come to us and they go through a broker who comes to us and goes, hey, these guys just got sold to private equity group. The PE group is looking to sale leaseback, free up the capital because they want to, do all those things I just mentioned. So it's a win-win. We come in, we're happy with the stability and security that comes with that single tenant and that lease structure. They're happy because they're freeing up the proceeds and capital tied up in the real estate that they can reinvest in their brand new portfolio company. And that's the reason why these sale leasebacks happen, and allows them to grow the company in a way they like, and allows us to be happy landlords.
Hey, real quick, and I don't know, I'm just curious because I'm picturing what you're saying, right? When somebody's selling you the property, are they vetting you in regards to how you're gonna come back and lease that property, or how does that work?
Oh yeah, because you are like you don't want to be if you're a real jerk about how you sell the property. Guess what? the tables are gonna turn right after you close on the sale. And it's funny talking to our people on our team. There's been a few times where Dax is like, I can't believe these guys countered with this provision. They're nickel and diamond. Like, don't they know, this is a long-term relationship. Yeah. A lot of them maybe are a little short-sighted. to really understand that piece that, hey, this is, you're going to need stuff down the road. And, you certainly don't want to start off with an onerous relationship with your new landlord. So,
yeah. Okay, cool.
Man, that's interesting because then, you're selling it, but they're going to be your landlord.
So you got to play nice.
Yeah.
I mean, both sides have to.
Yeah, and one more question that I'm intrigued, right, in regards to syndication and getting your how does the syndication and the exit strategy looks like? Because you mentioned you plan on holding it for 5 years, right? So how does that work and the returns and all that stuff for people that are listening to? And
I think you said longer, right? I mean, some of these are held for 30 years, but
no, the leases are for 30 years. But you say you plan on holding it for 5 years, right?
I'll jump in. Yeah, I'll clarify kind of the what that time frame or timeline looks like. So we'll get into contract with the property, and we'll syndicate these deals. And as soon as we get into contract with it, we send out an invitation to our investor group, say, hey, here's what we've got, and all the details about it. We share really everything. I mean, financials, the tenants. Usually more than most people ask for, but we really want to put everything out there. So people invest and we'll close on the property. And, we're simultaneously buying and executing that long-term lease. Like we said, 15 to 20 years is pretty common there. So, if you're every deal can be different. We don't run a fund. They're individual investments that we make and that we offer to investors. So, we may have something that's a little bit shorter term hold, but, that kind of 4 to 5 year time is sort of a sweet spot that we like. If we can do a little earlier and it makes sense, then great. And we've had some that are 5 to 7 years. That's not as common, but 4 to 5 years is pretty common. And, if we're selling at that time, you think about that lease, there's 10 to 15 years left on that lease. So that the property has a lot of strength and value due to a long, predictable cash flowing time period beyond, the sale of the property, right? Or the acquisition for a buyer. So it still meets a lot of criteria for some large REITs and institutions, but even some individual buyers may look at it and say, hey, this is fantastic. I want a triple net leased property that's got, at least 10 years, like I said, maybe 15 years left on the lease. So for them to go, this is great. It's really predictable. They didn't have to craft the entire lease. We did all that work on the front end, and it's a really great, institutional grade lease. It's got features built into it like quarterly financial reporting from the tenants, those annual rent bumps, and all these things that you would want in a good, strong lease. So there's a lot of value once we go to sell that because of that timeline left. If you have a property with 3 years left on the lease and you want a long-term investment, well, I don't know, does this tenant pick up and leave? And you just don't know. So there's a lot more risk if you don't have that long, runway in front of you for a buyer who's looking to buy this property from us when we go to exit.
And to piggyback on that, we talked about kind of encapsulating that operational risk when it comes to the net lease portion and removing expenses out. Another way we encapsulate operational risk is removing the need to go through a releasing event. So because we are, the first owners on these new leases, and because we always sell long before, the lease runs out, we never have to go through that period where, hey, will the tenant renew? If they do, what concessions do they want? Do we need a reserve to do, improvements for what they're going to want and play that whole negotiation game? And some people like, kind of taking on that risk and potential reward from the uncertainty of if a tenant's going to renew. For us, we just kind of remove that from our entire business model. And again, it's just one more variable we can understand and remove from what we're looking at during our hold period.
Pretty sweet. Drew, you mentioned something that got me kind of interested. So it is long. So, why choose just a syndication model and not do a fund? Would that change the returns? Do you get investors? Because I would imagine that you get investors that say, hey, can I keep my money in or what can I do at the end of the 5 year period? So have you thought of that? Just doing a fund or?
Yeah. No, it's funny. We just had a conversation about this and kind of shared had a, sort of an open fireside chat with our investment group. And we talked a little bit about that because it's certainly something, it's crossed our minds. We've had lots of discussions about it. We look at funds and individual investments that we do, and we've, coordinate and talk a lot with our investors who are really well experienced and kind of get their feedback too. And what you find is really funds there's a lot of separation between an investor and a fund. You really don't have any kind of control over what properties get sort of added to that portfolio after the fund is fully funded. And there's a lot less communication and feedback from a sponsor and that investor. It's sort of as soon as the fund is raised, there's a little bit of detachment, and you can make phone calls and request it all, but it's just not as transparent. It's similar to a REIT too, if you've ever invested in one. They'll give you little updates. Here's a picture and a little bit about it, but oftentimes you're not getting as much information as maybe you'd like, and also you're not able to make that decision, right? So we really like having that direct communication feedback from investors on each property. We have a great investment group. I really appreciate this every day because, when we have a property and we bring it to the table, we have investors who know what we're doing and understand how we mitigate the risks and find these quality investments, and they jump on board. So, luckily it's not something we can't do. It's tough if you can't raise, however many millions of dollars in a matter of weeks, then, it may be a tough type of plan for you. But if you can, like we can, then we're able to be a little bit more nimble and kind of look at each property individually. We could talk a lot about this question because it's a great one, right? Funds versus individual investments, but yeah. I'll throw it to Neil, see if he has anything to add to that.
I'd say the only last piece, people sometimes go to a fund and go, hey, I like a fund because I get better diversity. And we kind of mitigate that in that we have a fairly regular deal flow. On the average year, we do, between about 8 and 12 projects. So roughly every 4 to 6 weeks, we have a new one, usually in a very similar, risk return structure and profile. So we encourage folks, hey, there is a little bit of concentrated risk with the single tenant model, and that, it's kind of binary. They're either in or they're not. And to be fair, we've never lost a tenant, never had, a tenant default on a lease. We've been really fortunate on how we've chosen them, but, there is a little more concentrated risk there. So we usually encourage our folks, if they have the capital, to spread it out across, 3, 4, however many deals in a year. And that allows them to kind of have some built-in diversity. And frankly, I like the direct investment model because your funds are used more efficiently. In a fund, you kind of, you're forced to buy stuff. Otherwise, you have investor capital just sitting there.
Yeah.
And sometimes, maybe it's the right decision. Maybe it's, suboptimal, but you need to put those funds to work. Whereas, in a direct investment model, like Drew said, if you're able to raise the capital you need on time, it is the most efficient use of your investors' money possible. So, you're able to raise it, put it to work immediately, and return it when you're done.
I got to jump back in because that's a great point to make. If you have a fund, yeah, you have to put that capital to work. And is every investment going to stand on its own? And maybe not, right? You may have one that's okay, but if you presented it on its own to investors, would they jump in? So I really feel like we and our investors kind of keep each other sharp. We're forced to look at each individual investment and say, look, is this something that makes sense on all different levels? Can this stand on its own and withstand any kind of scrutiny? Because we scrutinize it a lot, and our investors certainly do too. We need to have answers for all this. How are we mitigating any kind of risks that could be foreseeable there? So if I have a fund, I may have a couple winners, but I may be playing a little bit looser at a certain point and getting a couple that are maybe not the best properties and maybe not getting anyone really excited. But at the end of the day, there's no control from the investors. It fits within maybe your guidelines that you gave out originally, but maybe it's not really even very high yielding. You just needed to make some acquisitions. So I think investors really a fund may be more beneficial to a sponsor, but I think it keeps us sharper to be individual.
So the bottom line is quality and not quantity.
I find if you look under the hood on most funds, you'll find one or two well-polished turds that got thrown in the mix.
Always, man. Yeah, no, that's true.
Very shiny golden turd.
But I like what you said about, you being able to talk to your investor base. That's key, right? I mean, especially as you're building your investor base. I like that about you guys. German, what else you got?
No, man, I'm fascinated about the subject. And one part is because we had a deal recently that we were trying to acquire, and it was actually a multifamily building. I think if I remember well, 50. It was a net lease. We've never seen it. I've never seen any multifamily where an entity would lease all the apartments, and we basically wouldn't worry about anything. So that's why I love the subject. I just never heard it before on buyback, which is really awesome.
Yeah, the sale leaseback model.
The sale leaseback, yeah.
Kind of that one more level into just an option to acquire.
Yeah, I love the subject.
And it seems like a very small niche market. So I think you guys mentioned it, but all of you guys operating in that space know each other and just keep selling back to each other. Making money. I love it.
Yeah, we're fortunate. I think the transactional structure of a sale leaseback is becoming more well known. So more businesses are entertaining that, and more private equity groups are utilizing that, which is nice because it's kind of opening up additional deal flow opportunities, and we hope it continues at the rate it is.
Great, that's awesome. All right, guys. Well, if you can let the audience know where they can find you, if you have any deal going on, go ahead and advertise yourself. Let them know where they can reach you.
Yeah, absolutely. And I'll start. So Neil Wahlgren, you can get me Neil, Neil at magcp.com, 925-487-3978. And myself or Drew, you want to introduce your side?
Yeah, I'm surprised you're putting your phone number out there. You're going to get all ballsy.
Yeah, that's ballsy.
Well, we can redact that, right?
Clean that up in post. Drew Wahlgren. You can email me directly, drew@magcp.com. And you can even go to our website and register over there at our website, magcp.com. And I think there's a portion that says where you found us, and you can, reference this podcast. That'd be great, just so we kind of know how you found us. But we have, like Neil said, a pretty consistent deal flow. So reach out. We do kind of want to have a initial call to sort of get to know each other and establish that connection before we sort of include them in future offerings. But it's a nice pipeline of deals, and if people are interested, they should reach out so they can take a look.
All right, guys. Well, thank you so much. And, it's been an honor having you guys on.
And thanks so much for having us, guys. Enjoyed it.
Fun.
All right, brother power, right?
Oh, yeah.